Hello, I'm Kelly O'Byrne and welcome to LCG's preview for the week ahead. I'll be talking to our Head of Research, Jasper Lawler, to discuss expectations for the Bank of England meeting and the effect it's had on the pound, the latest on Brexit, US inflation and a possible short-term top in oil prices. But before that, I'll run down some of the top corporate results to watch this week. It's a slow start on Monday, but Continental AG, E.ON, JD.com, TripAdvisor and Walt Disney are reporting first quarter earnings on Tuesday. Then Compass Group and Imperial Brands reports first half earnings, and UniCredit, Siemens and 21st Century Fox report first quarter results all on Wednesday. BT reports full year earnings, then WorldPay, Dropbox and Nvidia report first quarter numbers on Thursday, and finally ArcelorMittal report first quarter results on Friday. Now moving on to the economic calendar, it's a bank holiday in the UK and Ireland on Monday, but then Tuesday there is China and German trade data. On Wednesday it's US producer prices and the RBNZ rate decision. On Thursday there is China inflation, UK industrial production and the Bank of England rate decision and their minutes. Then US CPI inflation and finally Canada unemployment on Friday. So Jasper, this Bank of England meeting's been a bit of a head spinner. Tell me more.
I know, yes. I mean, well, the backdrop obviously in terms of markets is the pound has absolutely nosedived, had that false breakout to new multi-year highs, and then we've just been down almost every day since, and we're right down at the bottom of the range, right down at the 200-day moving average. Why? It's, a lot of it comes down to this meeting this week. It was almost 100% they were going to hike rates, the Bank of England, and then we had Mark Carney first showing a bit of caution about it. That really set the slide off. And since he's shown a bit of caution, basically saying, oh, well, May is not 100%, even though markets are saying it is, since then we've had the data to back up his comments. So GDP in the first quarter barely grew. And we've had these services and manufacturing PMIs, which have been pretty disappointing for April. So not just the rearview mirror, but forward-looking data all pointing to a bit of softness in the UK economy. Probably not really the time to be raising rates. So I think the consensus now is out to autumn. And obviously a lot of change can before then. So maybe we don't even get one this year. Yeah.
And I assume the renewed Brexit uncertainty is helped the prospects for the pound.
It's been a double whammy of all the Bank of England rate rise and the Brexit uncertainty together. Both reasons to peel back your long positions in the pound. Basically, we knew that the transition agreement was okay, but we knew that the crux of the deal was very uncertain, and that they'd kind of fudged through the transition agreement in terms of the Irish border and then what that means for the customs union. And so, whatever the result, there's going to be political uncertainty and a political backlash against Theresa May. If she opts to keep the UK in some sort of quasi-customs union, then obviously anyone who voted to leave are saying, well, why did we even bother? We may as well stay in the single market. And, if she actually does go for outside of a customs union, it looks like that means a hard border in Ireland. So obviously, either way, not a great result. Yeah. So hence the drop in the pound. I think it can actually stabilise, but I think because of the steepness of the decline in the pound, it's going to take some time to get us back up there again and the confidence to be restored.
Okay, fine. And now we've had the Fed rate decision last week, and now we've got US inflation data this week. Are you still thinking 3 rate rises this year in the States?
Well, one of the more interesting things about that Fed rate decision last week, obviously they didn't do anything, so that wasn't the interesting bit, but it was the fact that they pointed to higher inflation expectations, both in terms of markets, which we kind of know from the numbers, but also amongst themselves. They changed the language a little bit to say that actually inflation, excluding food and energy, is getting close to their 2% target, rather than before it was sort of implying that it's almost there or not quite there yet. So that would, to me, imply that the four rate hikes this year is becoming more likely. But still, I think the fact that the Fed are not acting in isolation is one reason why it might still be 3. So while in the US, inflation expectations and the actual data itself are pretty much at that target, elsewhere in the world, notably the Eurozone, is nowhere near. So we had 1.2% inflation in April for the Eurozone. So if the ECB aren't going to be tightening policy and the BOJ are probably going to be equally slow, then how fast can the Fed go? How much can they differentiate themselves from the rest? Not much, I would say. So that might be a reason that actually maybe we're getting a little bit overzealous here on reasons to be bullish on the dollar.
Okay. And finally, it's been quite the run on oil prices, but you think we could be topping here? So, or at least for the short term?
Yeah, at least in the short term. I mean, looking at the charts, there seems to be some pretty heavy reversal action going on around that $75 mark in Brent. But I think also what has been underpinning this rise in the oil price has been the uncertainty in the Middle East. Now, that hasn't necessarily gone away, and it looks more than likely like Trump will back out of this Iran nuclear deal. And obviously, going back on that, it's the fact that they've signed this deal is what allows Iran to export oil again, and obviously that floods the market with supply. If the deal's reneged on, then obviously that suddenly imposes tariffs on oil again, reduces potential exports out of Iran. So that all makes sense, but I think it's largely priced in now. We've had quite the run-up, like you said, and there's still quite a good chance, I think, that actually the deal remains in place, if not maybe just modified somewhat. And so in which case, oil prices are probably too high at these levels.
Yeah, okay. Thank you, Jasper. And thank you all for watching. If you wish to get these videos as they're released, please follow LCG on social media.